Okay, well, good morning, Checkmate crew. It's 30 minutes after the opening bell of the New York Stock Exchange at 10 a.m. Eastern Time on today's Wednesday, December 28th, 2022. Yours truly, Mickey Blindside here with your market memo. Okay, well, today we're seeing really not that much action. A lot of the professional traders, most traders, professional or retail, they are on vacation. Um, Volumes are light as well as just general activity overall is pretty light. I mean, you might see some big price swings in individual stocks as volumes are low. There's less order flow, so you may be able to push some of these smaller stocks up and down. But I think the indices are probably just going to be chopping around here for a bit today and tomorrow because these are the last two market memos for 2022. Today, we're going to go over, the liquidity data and all the things that are happening, of course, as we usually do, but we'll also take a look at what has worked and what we're looking forward to for 2023. And we'll pepper that in today and tomorrow with our usual stuff that we cover. So I just wanted to give you guys kind of the tempo of what we're going to be looking at today and tomorrow. So right now, S&P 500 is up about a little bit under 1/3%. Let's see where it ends for the day. Volumes have been kind of light, like I said. Yesterday, I went over the phenomena of the end of year options expiration. I still think that's a trade. I know the chance of it getting there and giving us that opportunity may be quite low. I mean, we're talking about, yesterday we said that we have all this open interest and the call side for the end of year, a lot of that being opened in June or earlier in the year at around that 400 to 405 zone. If we see that SPY gets to that area before Thursday end of day, I think that would be a very compelling short trade just because all those call sellers will have to roll their calls. They'll probably roll it either to the June expiration or to the end of year December 2023 expiration. We might see that happening. If it has to happen before Thursday end of day though. So the chance of us getting to 400, 405 in 2 days, I would consider that pretty low. I mean, that's like we would need two stellar days, like today and tomorrow would have to like just roar, and it doesn't look like it's going to happen. So most likely we're not going to be entering any trades. And again, the bigger picture though is, if we get to 405, what is it, 405, as our liquidity data is decreasing, yes, then I'll take a short. Now, after next week or so, if it gets to 405 and our liquidity data reverses and starts trending up again, I will not be taking a short there. So it really depends on our liquidity data. And with that, let's get to our liquidity data. We haven't really taken a look at that in a while on the market memo. Of course, we look at it on a daily basis on the Discord. And again, guys, I always recommend you guys to join our Discord. It's free. It's completely free. I don't charge anything for it. We actually make money trading here. So I don't really charge any subs or anything. It's just a good way to keep in touch and join the discussion and bounce ideas with one another. But right now, here is the junk bonds advanced decline line. I had a whole special segment. If you go on our YouTube channel and go to our special sessions playlist, it's the video that's right there. It's called the Junk Bonds Advanced Decline Line Special Session. Go ahead and take a look at that if you guys want a deeper dive into why this works or how to use this. But right now we've been seeing, for the last few days, our junk bonds advanced decline line has been going down. Okay. We saw the junk bonds advanced decline line make 4 up days in a row on October the 26th. And since then, it's been trending up. We had our first 4 days in a row of declines.
end on December the 20th. Okay, so around December the 20th, right around here. So we had 4 days in a row of declines. Okay, we had about, I think, 1 or 2 days of advances. Yeah, 1 day of advances and then 3 declines in a row. So in 8 sessions, in the last 8 sessions, we've only had 1 advancing day, and the rest of it have been declines. Okay, so so the junk bonds advanced decline line is decreasing. However, it's not decreasing very fast. Okay, usually the slope of that drop is usually a lot faster. We'll usually see declining issues over advances like 500, 600, 700, even up to like 1,000 in a day. We're not seeing that. We're seeing like 200s and 300s. I mean, it could be because it's the end of the year and volumes are light. So maybe next week we see that pressure exert itself a little bit more. It's all speculation right now. I don't know what's going to happen next week, but I'm just opening up the possibility of that happening, and they could happen. But right now, the decline is the slope of it is quite shallow. It hasn't been as steep as it was all year. All the rest of the year, it was a lot steeper. It's not as steep now. So again, I'm not sure if that's just the end of the year and just volumes are being light. And most traders, since I would say the 20th or so, a lot of professional traders have been off. It's been basically trading desks have been manned by the junior traders who are stuck at the office. But most of the senior traders they're in the they're in the Bahamas. They're out already. Okay, so we'll see what happens next week. Okay, but it is declining. All right, and our New York high-low line is still declining as well too. Actually, let's take a look. I want to just see what is today's. So today's is still mildly negative. It is curling down. We have some days where it's mildly negative. We have some days where it just completely falls off. So, as I've been saying, you've heard me say this multiple times when it comes to the New York Stock Exchange high-low line. There has been no meaningful rally or end of a bear market without this turning up. Okay. We usually continue a bear market if this keeps curling down, and we haven't had this line curl up at all year. Okay, there's been times where it's flattened, but it's never been able to get above all of its moving averages. Okay, and that's something that we just have not been able to see all year. And again, no meaningful rally and no end of the bear market unless this turns up. Okay, and I've looked at this since data since the 60s and 70s. And then when we look at the advanced decline line, is trying to make a comeback. We'll see what's going on here. If this goes up, market breadth is increasing, and if the market is going up as the New York advanced decline line, the New York Stock Exchange advanced decline line is going up, generally that means that we're going to see some strength in the small cap sector in the Russell 2000. I'm not going long on any indices right now. I would rather see liquidity data give us a better signal for that, and I think the time to go long may be sometime, I'm going to say maybe January, February, may be a good opportunity for us. I have my reasons to think that. We saw a lot of tax selling happening this year. All right. It happened actually around December or so. So, after 30 days, there's no more wash sales. So after that 30 days, I presume we might start seeing some buying happening again. And, I'm going to confirm that with large block trade orders, options positioning, and also our liquidity data. And once we get that signal, I'm going to start doing some long trades. But until we get that signaling, it's just all gambling right now. And right now in this low environment, in this low liquidity environment, I just don't see any reason. I don't see any reason to get long at this point. I don't see a reason to get short either, though. So right now, I think we're kind of in this no man's land. And rather than trying to fight the market and see, whether or not we're going to get chopped out or not, I think it's just better just to it's probably just better just to be patient right now. Okay. So right now I'm just being patient, but I think a potential trade is setting up probably in the next month or so. I think it's going to be a good opportunity to get long, and when that happens, I might start getting long with some leaps. Testing the waters out with some leaps. Small purchases here and there. Put some stink bids in, and just like we did back in I believe that was end of August or beginning of September. We put some stink bids in on the Russell on IWM, and we made a good, I believe it was like 60 or 70% off those leaps. I do think that the next time we get into leaps, hopefully we get a better rate of return than that. Usually with those leap strategies, I'm looking for 200, 300% on those returns, over the course of a couple of months. As we bought those leaps, we also saw liquidity data deteriorate within the next couple of sessions, and that's what prompted us to get out of that. But hopefully this time the liquidity data will remain firm, and if that's the case, hey, we could enjoy a pretty good run. But again, I think that's all speculation for now. I'm just anticipating what could happen, 5 or 6 moves ahead, just looking at those opportunities right now. Okay, so that is the S&P 500 and indices and our liquidity data. One of the things I also wanted to go over today was China. So yesterday we went over the relaxing of the COVID policies for foreign travelers in China. And so we saw the market really jump on that. Right now, the Hang Seng index, I believe overnight, the Hang Seng did extremely well. Let's just take a look. Yep, it did. It went 1.5%. At one point, it was up at around 2.5%. So it is starting to exert an uptrend on the daily chart, at least. And as I've always said, Australian dollar. When we talk about China, what do we always need to talk about? You already know. You already know what I'm going to talk about. I'm going to be talking about the Australian dollar. The Australian dollar right now is rallying really hard, actually. I think it's actually up to see our uptrend. This line, okay, and I know some of you guys hate diagonal lines. I know we got some members who really hate it, but it depends. These lines, I'm not a big proponent of TA myself. I do use it from time to time. And again, my philosophy is use it until it stops working. If you draw lines on a chart, you better make sure you know what point you're anchoring on. I do not eyeball any of my lines. My lines come from certain demand zones or certain events, or it could be like an exhaustion signal, big block trades. And currencies, you don't see big block trades, but usually with currencies, it's usually some type of event, or some type of exhaustion signal that I'm looking for. So that's usually where I anchor my points. But anyway, this downward trend has been exerting itself on the market. And this is a line that I drew back in 2021. And it's actually worked out really well for us. And there are days where it does, overshoot, or, weeks where it overshoots it. But I give it a 3-day rule. If it overshoots a level, it needs to stay there for 3 days, or it can get invalidated. And so we saw that here back in December, although it could never really make a new low on the daily chart or even on the weekly chart. It couldn't make a newer low. And I said, hey, remember, I said, if this keeps going up and if it holds above 640, and I said, it doesn't have to get to 640, all it does is have to stay above it, we may see a lot of strength coming out of China, and lo and behold, look at what happens. Okay, so this Australian dollar, indicator is actually pretty strong. Wherever the Australian dollar goes, that's usually where China goes. Sometimes it's about a week or two ahead of time, but it's still a very good forward-looking indicator, and it's because China buys a lot of its natural resources from Australia. So whenever the whenever big banks or institutions see that China is about to increase their industrial output, they start buying and hoarding Australian dollars in anticipation of increased trade and increased buying demand from China. And so we see that. And some of these institutional desks and some of these big banks that facilitate trade between the two nations, you think they're not stupid, and so they tend to be in the know, and they're usually very, very smart. Usually some of the smartest traders are, in the currency institutional desks. And when you see them acting, it's probably a good chance that they're right. Okay. And that's where the thesis comes from, or at least where the theory is behind using the Australian dollar as a forward-looking indicator for China. All right, and I've went over this multiple times, but I'm just going over it again just in case. But we are seeing it now testing this longer-term downtrend that we've seen in the Australian dollar since 2000 and 2001. Okay, if it busts out of that and it goes and we close, let's say, a week or two above this 690 level, I mean, I think then China's going to go gangbusters. I mean, we're going to see Hang Seng and all the Chinese stocks really just break out. That would be just adding gasoline to a fire. Okay, we could see this go way up if that's the case. Okay, and again, Australian dollar has to hold that 690, get above that, and hold it for about a week or two. And if that happens, I mean, we're going higher. We're going way higher. And you guys know what trade that I'm trying to do. I'm trying to get into ZTO. We're seeing a little bit of a pullback, not a lot. I may have to raise our buying level. I wanted to buy when it gets under 20. And that was, I believe, around the time when they had earnings. Yeah, it was around the time that they had earnings, and I said, "Ooh, for earnings, if it drops below 20, we're getting in." And lo and behold, that didn't happen. And so we'll see. We'll see what happens. I hope it does. I hope it does go to that level, but if it doesn't, it is what it is. Okay, it is what it is. If it doesn't get there, we'll have to find another trade for China. I know a lot of people have been DMing me about Baba and all these K-Web and all these tech stocks. Tech stocks are great, and in this environment, as Chinese stocks go up, we could see all the other stocks go up too, like Baba and K-Web and all these Chinese tech stocks. Hang Seng is mostly tech stocks, by the way. And so this is great and all, but the drawdowns are going to be pretty severe in this environment, especially in this lower liquidity environment. And again, that's the part of our thesis for a rolling bull market in 2023. It's just right now funds are limited, credit is limited, so it's not like we're going to see indiscriminate buying if buying were to happen. Okay, if we even see a mini rolling bull market in 2023, if we even see one, it's not going to be like one where we see every asset just getting bought at the same time. We're not going to see that. What we're probably going to see is targeted buying of one sector over another. One sector will go up, another sector will go down, and then there will be asset rotation amongst that limited amount of money supply that's out there. That's probably what we're going to see if we even get a mini bull market in 2023. And so in that environment, I kind of don't like to be in tech just because, your rewards could be great, but I'm going to be doing option strategies. So your implied volatility is going to be usually higher on a growth stock. And not only that, when you face a drawdown, it may be a more severe drawdown. And so I just don't want to be involved in something like that. I'd rather be involved in something like ZTO that's an industrial, that's got the macro kind of tailwind behind it, as well as they've got increasing free cash flow, increasing EPS, increased share buybacks, increased dividends, the whole story. So, this is what I'd rather be in. And hopefully in January or something, we get a little bit of a pullback. I don't know. And then, this will be, I think, a very good buy to make. So that's my plan going forward. Speaking of plans going forward, let me tell you a plan that did not go very well for us is the dollar. I mean, of course, I used it as a hedge, but it would have been nice to see this actually play out. It has not. We'll see. We'll see what happens. It was under 103 earlier today. We're back at 104. Okay, very good. So maybe we do have a chance. I'd like to see this go up. I really would. I mean, please give me this. If it does, I'd love to cash out those hedges and use those hedges to buy something else. And again, you guys know what I want to buy. The precious metal space, silver, gold. Silver is coming back down just a little bit. Gold down about 0.5%. And again, SILJ, that's where I want to be in. Hopefully in January, we get an opportunity to get into SILJ. It would be nice. It would be nice. Okay. What else are we looking at? So since we're on the commodity space, we might as well take a look at energies. Crude oil down today. I warned you guys about crude oil, that just because it went up for the last couple of days or, couple weeks doesn't mean we're going to start a new uptrend. I mean, the commodity cycles, people think that, we had 2 weeks in a row, 2 positive weeks. That's our go signal. No. Commodities take a bit much longer cycle. Even their the quote unquote short-term cycle can still last a year or 2 years, months at a time. So, I don't think that in this season, I think there's going to be a season for commodities again, but I just don't think it's now. I think it's going to be towards more like March, planting season, corn and grain planting season. That's probably when we're going to see another wave of commodity outperformance. And that's when I'd be more interested in going a little bit more aggressive in the longs. Natural gas, same thing. Ooh, look at that. Ooh, look at that drop. Oh, my goodness. Those of you who bought Boyle thinking that it was going to go up because of the weather, that was a bad idea, wasn't it? That was a really bad idea. I almost did it myself. Luckily, one of my alerts didn't trigger, but I saw that this was one of the most popular and most requested trades to look at about 2 weeks ago. So hopefully you guys kept your gambles small on this. I do think that natural gas coming down like this will probably will keep coming down like this, or it will chop around at these levels probably until that March zone, that February, March level for commodities. I am going to participate in that next commodities wave. Now, one of the things that I want to be looking at is the inflation stock is Mosaic, okay? Mosaic. Now, I suggested a short back here around 55 back in November. I should have taken it myself, but I missed it. I was busy that day or something. I was out and about and the alert triggered and I wasn't able to be in front of a terminal for this, which sucked. I mean, I really wish I would have been able to get in on this, but I wasn't. And lo and behold, it's down. Now, I do think that we're going to maintain this level. Mosaic is not going to do much. Mosaic is a fertilizer company, so it is the inflation stock. Whenever inflation goes up, usually Mosaic goes up. I am looking to get into Mosaic sometime around February, March, when the new commodity cycle starts. I will want to get involved in this. I will be using leap strategies most likely on this and be selling covered calls on this. Mosaic, I believe, yes, it does. It's got weeklies, so great. That's what I'm going to be using, weeklies for and selling weekly covered calls against a leap. Okay, I'm going to be getting in most likely around February, March. Hopefully, the commodities market will give us some sort of signal for this, which would be great. So that's Mosaic. What else? Mosaic is one. Another one that I might participate in is the actual commodities ETF, the broad commodity basket ETF, which is DBC. As you can see, DBC and Mosaic are very highly correlated. Actually, does DBC have weeklies? I think it does. No, it doesn't. No, it doesn't. So Mosaic actually has a better options market. So I may just stick with Mosaic. Yeah, I may just stick with Mosaic. Okay. So Mosaic is the inflation stock. Mosaic, and rightfully so, we were talking about a potential dividend increase. We talked about this back in earlier in the year, and lo and behold, they did do a dividend increase. And I think they're going to do another dividend increase probably around their April or the one after that, January, February, March, April, May, June, July. So either their April or their July earnings, I think they're going to raise their dividend. They're flush with cash right now. They've been making so much cash. So much, growth, from pricing power. And so I think that pricing power, it eased off a bit as natural gas came down, but I think when the new commodity cycle happens, this will be one of the places to be in. So I think it's still months away, but I'm trying to just anticipate, 5 or 6 moves ahead, to see where, we could get, some action in this. Hopefully we do. Hopefully this will be a good, hopefully the market will give us a good entry on this. And I hope this stays down there for the next cycle, but we'll see. Okay. If it doesn't work out, it doesn't work out. It is what it is. I'm just looking at opportunities that are on the horizon for the next couple of months. And Mosaic is one of them. Next on my list to look at, we looked at crude oil. CPG. I know some of you guys have been asking about CPG. Why not just dollar cost average? Because it could get lower. All right. And I want maximum value out of this. I've got so many other plays that I also want to get involved with as well. I'm not going to devote that much capital to any one trade. I'm going to be, spreading it around between 5 to 10 plays. And so I still want to have a significant amount of cash even after I do those 5 to 10 plays. So that's why I want to be really, really choosy. And right now there's I would say 20 candidates right now for us to trade within the next 3 months. And I want to be as picky as possible and get the plays that are going to give me the max value, and the max, odds on the best rewards to risk ratio. So I want to make sure that I get maximum value out of any trade that I take. So that's why I'm not going to be dollar cost averaging. I do think, though, in the next couple of months, we might see, diesel stocks go up. The stockpile, the actual supply of diesel could go up with all the with all the pumping that happened, and with all the refineries buying all the crude oil back about 2 months ago or so. All that is going to get distilled, and we're going to have diesel, I think, supplies go up within the next month or so, and that will probably put some pressure on energy markets, and I can see something like CPG coming down a lot lower. So that's why I'm not dollar cost averaging now. I would rather wait and get maximum value out of it. Now, if we miss it, oh well, we've got so many other plays. There's so much abundance of opportunities that I see in the next 3 months. There really isn't a reason to chase any of this. Okay. So that's my take. I know patience and discipline, it's not the sexiest thing to hear. A lot of people want action all the time, 24/7. I want to click buttons, from 9:30 to 4 every day. But that's, in my view, that is just not successful trading. The most successful traders that I know tend to be very patient, and they tend to pick their shots when the reward to risk is heavily in their favor. One of the independent traders that I know that does the best only takes 3 or 4 trades a year. Okay, he only takes 3 or 4 trades a year and probably outperforms a vast number of professionals. Just an outrageous rate of return every year. He's been doing it for over a decade. maintaining this rate of return. It's in the hundreds, it's in the 3 digits every year, but he only takes 3 or 4 trades and he leans into those trades. He puts like 20 to 25, sometimes up to 50% of his account into a trade like that. But he only takes 3 or 4 of those a year, and that's it. He doesn't day trade. He doesn't look at his account often. He actually, most of his time, he's not even on his terminal. And so that's the way to trade. And Jesse Livermore also talked about it a lot too. He didn't actually practice that. He also would he also let fear and greed get to him a lot, and he used a lot of leverage. That was what eventually led to his downfall. So don't do as he did, but do as he says. And we do have his book in our Discord. If you go there, there's a link to the book. It's a PDF that's online that you can download for free. But anyway, that is that's my rant for the day. Okay, so let's get to Bitcoin and Ethereum. I still don't see anything in the Ethereum or Bitcoin options market. I don't see anything there. The open interest is still quite low. Okay, the open interest is still very low. It's like 4.9 billion. So I'm not sure why the speculators aren't going into the options market. If anything, speculators are leaving the options market. Who knows? Maybe they're speculating on futures. That's something that I'll have to take a look at. But I haven't seen any type of unusual activity on Bitcoin or Ethereum. And again, I know you guys love to ask me about this, but again, patience and discipline, that's kind of my 2 words here. And that's, I think, is going to be a very important 2 words probably for the next 2 years. So I still am looking for ETH gold ratio to get down to this level, and that would be a very compelling buy level for me. I just don't see any trade right now here. And as you can see, it's kind of just been chopping up and down like this for since beginning of November. So if you got involved in this and you weren't quick to get out and lock in profits, you probably got chopped out a lot. This is a very much a stop loss inducing market. So if you guys are using leverage on this, you may be getting stopped out, unless, again, you guys are super active and you're taking small profits as you go. That's probably the way to play it, if you're going to even play this at all. For me, I'm going to stay out. This is just not enough juice for my liking. If I want to take a trade, I want to make sure that I get rewarded for the risk I take. And right now, these kind of movements, I'm not getting rewarded that much. It's just a lot of headache and pain and worry for not that much money. I want big moves, okay? Big moves that can last weeks. That's where the big money is. And right now, I just don't see any big money moves right now in Ethereum or in Bitcoin. That may change, and if it does, I'll let you guys know. But again, patience and discipline, ETH gold ratio, 0.59. That is what I'm waiting for, okay? Other than that, it's no man's land for me. I just don't see a trade at that point. Hopefully we'll see. Hopefully we'll see some changes to this. And tax selling. This is something that I went over in the beginning of the month in December. Okay, there's been a lot of tax selling happening, and not only in the energy names, but also in tech. We also saw tech, especially semiconductors, sell off at the same time as some of these oil names. And so that, that's how some of this tax loss harvesting works. You sell your winners and you sell the losers at the same time. The losses and the losers offset some of the gains in your winners. Okay. And this is how, portfolio managers can keep more of their gains in their winners, raise cash so that they can buy some more assets in the beginning of the year. A lot of portfolio managers do this at the end of the year. So a lot of tax selling happened starting in the second week of December. It happened a little bit later this year. So usually after a tax selling like that, portfolio managers will not re-enter that market or that segment of the market or that security for 30 days to avoid a wash sale. Okay. And that 30 days comes up in about a few weeks. Okay. Then about I would say about 2 or 3 weeks. Okay, after January starts. Well, we're already getting to the last few days of December, so probably around 2 or 3 weeks. In 2 or 3 weeks, we may see those institutions re-enter some of those tech names, and if it does, with the correlation this year with Bitcoin and small cap and NASDAQ, we might see a little bit of a boost in crypto then. And again, that's kind of my thesis on why I think in around February or so, we might see a big move in tech stocks. And right now, if I had to bet which way that big move is going to be, I would say it's to the upside. And so, but from then, it's still not tradable right now, because from now until then, we could drop further. So, there's no trade in it right now, but around that January, if we see like an exhaustion signal, if the market drops, we see an exhaustion signal, we see big block trades coming in, I think that would be a good sign for us to start getting long on some of the indices. And again, I talked about it in the beginning of this on this recording that I'll be looking for some leap strategies at that point. Peppering it in with some other names that we're looking at. Again, SILJ. If the dollar goes up as the market drops, we're probably we're going to see precious metals see some headwinds and possibly see a drop in precious metals. That would be a good opportunity for us to get into the metal miners as well. So there's a lot of opportunities that are looming, not just in the metals and the energy space, but I also think in the tech space, possibly even in crypto. Okay, but again, I'm not trying to predict the future. I'm just anticipating 3 or 4, or right now it's like anticipating like 10 moves ahead. So depending on what the market does, we may have to pivot those strategies just a little bit. But right now, I'm just planning for months ahead, and usually that's I find that I usually do way better in my rate of return when I'm looking at things months ahead of time and planning things months ahead. That way we can really have that sniper mentality and just snipe in right, and right in on that price that we want. And if we're wrong, well, at least we can just get out at a small loss. That's my biggest thing. There's no such thing as a perfect track record for a trader. Anybody who says that they got a close to 100% track record is usually lying to you. I mean, even my buddy who only takes 3 or 4 trades a year, he's still open to the idea of him being wrong. Now, 75 to 80% of his trades usually work out, but there's still that 20-25% chance. And he does exercise risk management. Sometimes he gets chopped out of a trade, very rarely, but he still is open to that idea. So for us, it's the same thing. If we're going to be a little bit more active, we have to be open to the idea that our hit rate may not be as high, but if we are wrong, I want to make sure that we take on the smallest losses possible if we're wrong. And so that only happens if we're patient and we look for clear levels at the edge of price structure, and that is the way to go, in my opinion. And so right now, I don't see any trades that we can take immediately, but I think within the next month or two, I think there's going to be a lot of opportunities that present themselves. And I think one of them could be crypto, as it just kind of tracks what the tech market is going to do. And if tech goes up, I think that's going to be a sign that liquidity is improving and that institutions are getting ready to buy with assets. There's still a lot of cash out there, guys. We talked about this before. We talked about using foreign currencies, the euro, the British pound, and the Japanese yen as forward-looking indicators. And the reason why is because a lot of overseas dollar-denominated accounts, they're still flush with cash. Okay, they're still making a good 4.5%, 5% on those accounts right now. And, some of that money has made its way into the markets in the end of November, early December. But I still think that there's a ton of money still, a ton of cash still in those accounts. And if that money will need to find a home at some point. And I think in the next month or so, after all these, after all the tax selling, effect has worn off, and after 30 days, and after there's no more wash sale possibility, that's when a lot of this institutional money is going to start going shopping again, especially if we see prices come down I think a lot of institutions are going to go bargain hunting again. And again, we're in a limited credit kind of environment. So it's not going to be like all the indices are going to just go way up. It's not going to happen like that. It's not going to be indiscriminate buying. It's going to be like this low volatility kind of rolling bull market where certain sectors really go up, certain sectors come down, and it just rotates through sector by sector, probably for a few months. And I think that's going to be our quote unquote mini bull market. And I think tougher times probably lay ahead in 2024. Everybody's calling for a recession in 2023. I just don't see that. Okay. I don't really see that. If we did, something like transports would be like, transports would be just being decimated, but that's not the case right now. If you look at the transports over utilities, which is a very good forward-looking indicator for when a recession happens, usually you want to see this like just plummet, okay? But that's not what we're seeing right now. And not just that, with the consumer being this strong, I just don't see that happening in 2023. Now, 2024, completely different story. I think if the dollar keeps going up, I don't think the dollar is going to just just fall off a cliff here. I think it's just going to chop. It's very possible that the dollar just chops around here. But as commodities come back up in price, which I think is going to happen around March, April, we could see that inflation expectation go up. And if inflation expectation goes up, we could see the dollar go up, which is going to cause this feed loop of where a lot of foreign governments and foreign entities and organizations, they're going to have to hoard more dollars because the cost of their commodities going up. They don't want the dollar running away from them and incur even a larger cost in acquiring commodities. So they might start hoarding dollars. And again, that's going to increase the price of the dollar. And that might put a lot of stress on emerging market central banks. And I do think that a solvency issue could be on the horizon, not in 2023, but closer to 2024. And if inflation is still high, as we have that solvency issue, what is the Fed going to do? So in 97, 98, we had something like this. We had the Asian financial crisis or the IMF crisis. But at that point, inflation was really low and the Fed was able to inject stimulus into the market. They were able to inject liquidity and drop interest rates. Well, do you think they're going to do that when inflation is high? I don't think so. They're going to have to allow things to break. This is not, if you think this is bad, this is nothing. Okay, this is really nothing. If you thought this quote unquote recession, that everybody's been talking about for the past 6 months, if you thought this was bad, it's really nothing compared to what a solvency risk or a solvency situation could look like on a global scale. And I think that I'm not a sensationalist. You know this, guys. You know that I always tend to not buy into those kind of stories. But right now, just from the data and just from a historic perspective, I am starting to see the setup for that rhyme, to be played out again. And I think, but you need time for something like that to play out. That kind of stuff doesn't happen immediately. It takes time. And I think around 2024, that's when it happens. And I think it's going to catch a lot of people off guard. I think a lot of people are going to get caught off guard on this mini bull market that I see happening in the next, I don't know, a couple of months. And then everybody's going to get on this bull market bandwagon at the very end, of course. And I think this next mini bull market is probably going to be one of the most hated bull markets. The last time we had a rolling bull market, it was 2017. It was one of the most hated bull markets, least participated bull market in recent U.S. history. And I think that's going to happen again here. I think we're going to have a rolling bull market, probably going to last a couple of months. And then when everybody's, says capitulates and their puts are no more and everybody's been shorting the market and they can't take any more shorts, once they start getting long, watch. That is when the solvency crisis, that's when all the solvency stuff is going to come out. That's around the time when all these emerging markets also are going to have to pay debt servicing costs for all the debt they have. And guess what? Most
world debt is denominated in US dollars. So if the US dollar is up, inflation expectation goes up, those costs are going to go up too, adding to that solvency risk scenario that I'm talking about. But again, who knows? I don't have a crystal ball to this. I'm just anticipating now that, if what we talked about before, all those plans for silver and buying leaps on indices, if that's looking 5, 6, or 10 moves ahead, I would think that this solvency risk thing is more like end of game 20 moves later, okay, kind of a thing. All right, so I'm looking way ahead. There's nothing actionable right now, but it's something that I'm planning on, just getting my mind ready, so when it does happen, I have a plan. I'm not acting on emotion. I'm acting on conviction, and conviction based on data. All right, and that's the most important thing. Anything else you guys want to look at? Any questions, comments, rude remarks? How do you think, somebody's asking us this, how do you think it compares to 2008? 2008 wasn't that bad. If you really think about it, 2008 wasn't really that bad. It was just let me rephrase that. 2008 was a systemic issue that was caused by over speculation in the real estate market. And so, yes, you had certain key institutions fail because of that, and a lot of banks failed because of this. Now, banks are much better capitalized today, so I don't think that we're going to see like bank failures per se. We might see something like Credit Suisse or Deutsche or something like that fail, but in comparison, that was fixable, right? Because inflation wasn't that bad. If in 2008, you have to understand that the Federal Reserve started tightening back in 2006, 2007. Okay, they started raising interest rates and tightening. So inflation really wasn't that bad in 2008 when all the banks failed. So that's why they were able to inject a lot of stimulus. They did TARP, they did all the asset buying, plunge protection, all of that came from 2008. Now, fast forward here, if we have emerging market solvency risk, all right, where central banks in emerging markets, they are having issues, that's a different scale. And not only that, the Federal Reserve won't be able to act if we still have high inflation at the time when this happens. If we have high inflation at the same time, there's no way the Fed is going to inject more stimulus and drop interest rates in order to facilitate, emerging markets solvency crisis, solvency risk. There's just no way. They won't have that weapon at their disposal. So what are they going to do? They're probably going to have to let some of these emerging markets fend for themselves. Again, back in 97, 98, we had low inflation, so we had the Fed be very accommodative in that. I just don't think the Fed is going to be very accommodating in this environment. If inflation goes up at the same time, we have that solvency risk. It feels like this time it will be the pension funds. Mitch, you know what? You are absolutely correct in that. We've already seen pension funds fail. Actually, remember back in end of September, early October, when the Bank of England came out and initiated a form of yield curve control by buying the Gilt, buying their bonds. Remember, they had raised interest rates, but then right after they raised their interest rate one time, they had to go and buy their long-term bonds. There was a reason for that. It's because their national pension, England is very different than the United States. They're more of they have a little bit more of a socialist leaning. They have a lot more social safety nets. They have this national pension, very similar to our Social Security. But I believe it covers a lot more people. But anyway, their national pension was about to go under. So it was their national pension lobbied to the Bank of England and said, look, if the bonds in our balance sheet go down in value, we're going to get a margin call. I believe the data said at the time, I gotta bring up all the reports that I had back then, but if I recall correctly, I think the national pension in Great Britain, I think they were like a week away from a margin call. So if the Bank of England did not act at that moment, they would have had forced liquidation. And a lot of people would have lost their pension benefits. And that would have been total catastrophe. That was Bank of England. This is not some like emerging market country. Well, I mean, after that, pretty much Great Britain's assets got classified in the emerging market risk basket. A lot of institutions just did away with buying British assets after that, but much like they would, an emerging market country. But anyway, that's a totally different debate. But we already saw cracks forming in the system. Okay, and starting with the Bank of England, and again, we see cracks little by little, and then it happens all at once. That's how usually markets work, little by little, for long periods of time, and then everything comes crashing down all at once. And again, that takes time. I don't think that's going to happen in 2023, but I think more closer to end of 2023, 2024, that's when it happens. I just don't see it happening in the first half of 2023. If it happens in the first half of 2023, that means we'll have seen this cycle play out much faster than anything else, which I think even if it happens in 2024, that's really fast. So I'm accounting for the markets being 2 or 3 times faster than what it used to be. And it's still, I think it's going to be around 2024. It could happen in the second half of 2023, but I think the chance of it happening in the first half of 2023 is actually quite low. It takes time. I think the commodity markets need to come back, and that's not going to come back until March, April, until planting season. Inflation expectation needs to go up. And I think, again, the dollar needs to go up too. There needs to be a lot more pressure to buy those dollars. And again, I think that's going to take time. It's going to be closer to when those emerging market bond debt servicing payments are due. And that's due, I think, around June, July of 2023. So it is going to be after that point, in my opinion. Okay, and again, we'll see it. We'll see it in the data. We'll see it in the cracks in the data. Our junk bonds ADL will pick that up, and we will be prepared for that. Okay, we'll, here at Checkmate, we don't, nothing will pass us. Hopefully, nothing will pass us. June 9th was one of those things that passed everybody. Nobody saw that coming, but generally, we see it coming. The data usually shows us weeks in advance. Hopefully, that answered your question. Anything else you guys want to look at? Oh, I'm just looking at my other computer right now. It looks like our YouTube feed got cut. We're dealing with some power issues here in Los Angeles. I live in the West Coast, and because of all the rains and all the storms we've been having some crazy power demand. And I think the internet's going in and out because of that. I will post a recording. I have a hard drive recording of this presentation, so I will be uploading that on YouTube. It takes me a little bit longer to upload from the hard drive. It'll take me like a couple of hours to upload this. So be patient, guys, if you guys want to watch the replay. But I will have this up soon. Okay. All right. Any other questions, comments, rude remarks, anything else you guys want to look at? And again, tomorrow I'm going to be looking at tomorrow we're going to be looking at what worked in 2022. We're going to review all the trades. I think it's very important to take a look back. I like to do this on a quarterly basis, but at least on a yearly basis, you guys want to look back and say, hey, what worked, what didn't? What can we plan on for next year? Things like that. I like to reflect upon this on a quarterly basis. Some people do it on a monthly basis. I know some professional traders who do this on a monthly basis. I know one day trader who will actually do this on a daily basis. I think that's a little bit too much. I like to do it on a quarterly basis, but at least on a yearly basis, we should do this. As a group, we'll do this tomorrow. We'll just take a look at what worked last year, what can we use still for next year, and what will we need to change next year based on our data. I'll go over that tomorrow. Okay. So in that case, that wraps up our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people
people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, again, tomorrow, 10 o'clock, 30 minutes after the opening bell of the New York Stock Exchange. That will be our last session of the year. And then next week, hey, new year. We'll, as always, we'll be here Tuesday, Wednesday, Thursday, 30 minutes after the opening bell of the New York Stock Exchange. And I'll post the schedule on our Discord. All right, guys, trade safe. I'll see you guys tomorrow.